is loud. It arrives every morning as a stream of urgent messages. A new discovery, a new warning, a new forecast, a new crisis. Markets react in real time. Social networks erupt in milliseconds, and in the middle of all this movement, investors are asked to do something that feels almost unnatural. They are asked to think clearly. This is not about what happens next week, but about the effects that compound over the next decade. The truth is that the greatest financial outcomes are rarely created in the loudest moments. They are built through quiet decisions that survive multiple cycles. Decisions made when the future is uncertain, when timelines are vague, when the crowd is impatient, and when the only real advantage is structure. If you want a symbol of this mindset, consider someone like Elon Musk, not as a headline, not as a personality, not as daily news, but as an archetype, the future-focused builder, someone who chooses problems that take years, sometimes decades to solve, someone who bets on technology not because it is fashionable, but because it can change the economic dynamics of what is possible. You don't need to admire every decision to learn from the structure of the thinking. Elite investors, especially those who endure, are not trying to predict the future in a precise cinematic way. They are not trying to guess the exact date of the next recession or the exact peak of a market cycle. They are doing something more practical. They are trying to understand which forces are durable, which narratives are fragile, and where time can turn small advantages into meaningful wealth. And if you pay close attention to how the best investors speak, you'll notice a pattern. They don't seem to be in a hurry. They don't seem to need to be right immediately. It feels as though they are managing a process. That is the first difference. Most investors see the future as a series of emergencies. Elite investors see it as a set of probabilities. They don't ask, what will happen? They ask, what could happen? And if it does, what would it mean? This is not a matter of semantics. It changes how you allocate capital, how you size risk, and how you behave when the world refuses to cooperate. Because the future is not a one-way road. It's a highway with exits you only see when you're close. And in markets, the goal is not confidence. The goal is preparedness. Being prepared means you can survive more than one possible outcome. Being prepared means your portfolio doesn't need a perfect timeline. Being prepared means not confusing a strong opinion with a competitive advantage. This leads us to one of the most important ideas in long-term investing: the difference between noise and signal. Noise is what demands your attention. Signal is what deserves it. The market is an extraordinary machine for generating noise. It has to be. Prices move every second because people are constantly trading risk, time, and uncertainty. But the forces that shape long-term returns move more slowly. They are structural. They are persistent. These forces include the cost of capital, the strength of balance sheets, the durability of cash flows, the trajectory of productivity, and the incentives that drive human behavior. A single inflation print can dominate the news for an entire day. But long-term inflation is shaped by multi-year dynamics: wages, productivity, supply chains, energy systems, and policy choices. A single earnings report can move a stock price by 10%. But value creation over a decade is shaped by something deeper: a company's ability to reinvest profitably, defend its advantages, and adapt to change. Elite investors build their strategy around these deeper forces. They understand that short-term movement can be real and painful, but it is rarely the main point. They treat short-term volatility the same way you treat the weather. The weather can ruin your afternoon. It can even cause damage, but you don't confuse weather with climate, and you don't rebuild your entire house every time it rains. The smartest investors don't take a long view out of neglect but out of strategy. They understand that time is a valuable resource. Time creates the space for fundamentals to prove themselves. Over time, competitive advantages translate into cash flow. Time allows reinvestment to compound, and it is time that makes compound interest possible. Compounding is often explained as a mathematical equation, but in practice it is a behavioral test. It requires you to hold on through boredom. It requires you to endure periods when progress is invisible. It requires you to resist the temptation to abandon a good process for an exciting story. That temptation is everywhere. It shows up when markets are rising and you feel left behind. It becomes obvious when markets fall and you feel foolish. It appears when someone else seems to be getting rich faster than you. And it emerges when the future feels uncertain and certainty becomes seductive. Elite investors don't eliminate these emotions. They simply stop letting those emotions dictate the strategy. They create rules. They set boundaries. They build a time horizon that can survive discomfort. Now, to think about the future like an elite investor, you need one more shift. You need to stop treating the future as a prediction and start treating it as a landscape. A forecast is a single line. A landscape is terrain. In a landscape, you don't ask for exact answers. You ask what is rising, what is falling, where the rivers are, where the bottlenecks lie, and what tools you need to cross them. That is why patterns matter. Not patterns in the sense of mystical certainty, but patterns in the sense of recurring dynamics. Cycles of credit expansion and contraction. Cycles of optimism and fear. Cycles of leverage that quietly build during good times and break loudly when conditions become more hostile. Human psychology is the most consistent force in finance. That is why bubbles can emerge in different centuries with the same emotional shape. Early winners. Rising confidence. A story that feels inevitable. More bargaining power. More participation. Then eventually disappointment arrives, often triggered by something small. And when the story unravels, the future that once felt certain suddenly becomes impossible. Elite investors study these cycles not to predict every peak, but to understand fragility. They ask, what assumptions are embedded in current prices? Which parts of the system fail first if conditions change? Where is the leverage? Because leverage is the accelerator. It makes gains look brilliant, and it makes mistakes fatal. The best investors hate catastrophic outcomes more than they hate being wrong. That is the essence of risk management. It is not about avoiding losses. Losses are inevitable. It is about avoiding losses that take you out of the game. The future belongs to those who can stay in the game. And staying in the game means respecting what you cannot control. You cannot control interest rates. You cannot control geopolitics. You cannot control competitors' responses. You cannot control recessions. But you can control exposure. You can control position sizing. You can control liquidity. You can control whether your portfolio requires perfect timing. Now let's return to technology, because the future is often presented as a technological story. And it's true, technology is one of the most important drivers of long-term productivity and wealth creation. But elite investors don't invest in technology simply because it feels futuristic. They invest when it changes the economics, when it lowers costs, when it increases output, when it removes friction, when it improves coordination, when it shifts bargaining power. Technology is not automatically profitable. It can be transformative and still be a poor investment if the price is wrong. This is another key difference between amateurs and elite professionals. Amateurs fall in love with the story. Elite investors separate the story from the price. They ask whether the expected future is already priced in. Because markets don't reward you for being right about a narrative. They reward you for being right when the price is wrong. Price is what connects optimism to mathematics. And mathematics is what determines whether a great company becomes a great investment. This is where the archetype of the visionary builder comes into play. When you imagine someone building for the future, you are imagining long-time horizons, high uncertainty, and constant iteration. That is the true essence of innovation. Innovation rarely follows a linear path. It is progress followed by delays, breakthroughs followed by bottlenecks, a surge of enthusiasm followed by skepticism. The market tends to make two mistakes when it comes to innovation. First, it assumes that because something is possible, it will happen quickly. Second, when something doesn't happen quickly, it assumes it won't happen at all. Elite investors live in the middle ground. They respect direction without demanding a timetable. They pay attention to adoption curves. They study unit economics. They look for the moment when a technology becomes cheap and reliable enough to move from demonstration to infrastructure, because it is in that transition from novelty to infrastructure that durable wealth is often created. And this is where patience becomes more than a virtue. It becomes a strategy. A patient investor is not someone who waits passively. A patient investor is someone who selects investments with room to mature, someone who allows time for reinvestment to do its work, someone who can hold through volatility without being forced to sell. Being forced to sell is what destroys long-term plans. It's what turns a temporary drawdown into a permanent loss. That's why elite investors maintain liquidity. That's why they avoid fragile leverage. That's why they structure their lives so their investments don't have to solve short-term cash flow problems. Because the most valuable part of the future, a compound interest, only works if you can stay invested. Today, the concept of compounding is often misunderstood. People imagine compounding as a smooth, steady climb. In reality, compounding often looks like long periods of modest progress, interrupted by sharp declines and unexpected recoveries. It rewards endurance. It rewards the ability to maintain the process when the environment tries to break it. That is why discipline is not optional. Discipline is the bridge between a good idea and a good outcome. Without discipline, even the best thesis turns into a short-term emotional trade. So how do elite investors maintain discipline? They simplify. They reduce decisions. They commit to time horizons that match the nature of what they own. They focus on what is knowable, the strength of the balance sheet, the durability of demand, the quality of management's capital allocation, the competitive landscape, the price paid for cash flows, and then they accept what is not knowable. The exact timing of market entries, exact policy decisions, exact technological timelines, exact human reactions. This acceptance is not a sign of weakness. It is professionalism. It is the recognition that investing is not about certainty. It is about decision-making under uncertainty. And this brings us to the psychological core of elite investing: emotional control. Markets don't just price assets, they price human emotions. Fear pushes prices below intrinsic value. Euphoria drives prices above intrinsic value. And in both cases, the future becomes distorted. When people are afraid, they imagine a future where nothing improves. When people are euphoric, they imagine a future where nothing can go wrong. Elite investors observe these moments and ask a more measured set of questions. What is the market assuming? What is being ignored? What exactly is being overpaid for? And just as importantly, what is being undervalued because people are tired, scared, or impatient? This is where long-term wealth is often created, not through speed, but through temperament. Temperament is the ability to maintain a reasonable view even when the crowd becomes extreme. The ability to keep risk under control when prices are rising. The ability to keep courage intact when prices are falling. The ability to say, I will not be forced into a decision by a headline. None of this requires dramatic trading. It requires structure. A portfolio built for multiple outcomes. A process designed for volatility. And a life built to sustain patience. Now, when you combine technology, compounding, and discipline, something important happens. You stop chasing the future. You start positioning for it. You begin to ask better questions. Instead of asking, which stock will explode next? You ask, which companies can reinvest at high returns for a long period of time? Instead of asking, what will the market do this month? You ask, is the cost of capital rising or falling? And what does that change? Instead of asking, what is everyone talking about? You ask, what will still matter 5 years from now? This is how elite investors think. They don't need their portfolio to entertain them. They don't need to feel good every day. They don't need a perfect story. They need durability. They need survivability. They need a reasonable set of exposures that can benefit from progress without relying on fantasy. Because progress is real. Productivity can increase. Companies can innovate. The economy can grow. And over long periods, ownership of productive assets has historically been one of the most reliable ways to build wealth. But the path is not easy. And the future is not polite. It will test your patience. It will test your confidence. It will give you moments of excitement that tempt you to abandon your process. And it will give you moments of fear that tempt you to sell good assets at the wrong time. So the real question is not whether you can see the future. The real question is whether you can build a strategy that remains intelligent when the future refuses to be clear. A strategy that respects technology without idolizing it. A strategy that understands innovation without overpaying for it. A strategy that values compounding enough to protect it. A strategy that survives. If you think back to the future-focused builder, the archetype we began with, the most revealing trait is not ambition. It is the willingness to work on a long timeline, to accept uncertainty as part of the process, to keep iterating without needing immediate validation. That willingness is rare, and in the world of investing, it is powerful, because it aligns with how wealth is actually built, slowly, and then all at once, not by luck, and not because of a perfect forecast, but because time amplified good decisions. That is what the smartest investors understand. They think in decades, not days. They respect the future, but they don't chase it. They prepare. They remain disciplined. They keep risk under control, and they allow compounding to do what it has always done, quietly turn patience into progress.